For the morning, our Diwali guest, Shankar Sharma of First Global joins us now. Shankar, good morning. Thank you very much for joining us. Where do I start, actually? The Nifty has not given us too much by way of gains from last Samvat to this Samvat, barely 1% negative. How would the year ahead be, Samvat 2072, for the Nifty itself?
I mean, okay, so first things first, my view last year was, if you look at election as being the big factor of 2014, my view was nowhere close to the consensus view that things are going to change dramatically for the better if a certain party is voted to power. And I found the whole sort of mass hysteria around the election results, or even leading up to the election results, to be extremely underanalyzed and very oversimplified. And it has nothing to do with the person in question. It is simply to do with the fact that in a very complicated and troubled global situation, to expect one person to have a secret that none of us who are engaged actively in watching macro and micro, that none of us have any real clarity on how things will develop globally, to expect that one person knows exactly what is to be done, he has the keys to the kingdom. I found that to be a very childish perspective, and I'm sorry to say, but every fund manager that you can care to name, or every sell-side analyst you can care to name, just forgot that we are getting paid to critically analyze management views, whether it is the management of a company or the management of a country. We just assume that he knows something that we don't, and guys, let's just go with that. I mean, that is a very, very, puerile way of looking at, analysis. So I never belonged to that camp, and I still don't belong to that camp. I'm not a cult worshipper of anything, not even God.
Okay, but Shankar, take your point about oversimplification of the political narrative, but tell us, how does the year ahead look to you?
My view is that as far as our macros are concerned, they look okay. As far as the micros are concerned, which is corporate numbers, because ultimately, we need to see corporate numbers rather than just look at GDP numbers, and we all know how the GDP numbers have been given a color which none of us actually can buy or digest. So let's forget about that make-believe number. Let's come down to hard numbers, and the hard numbers are corporate numbers, and you know exactly where they are, and we all kind of agree on one thing, that definitely for the next quarter or two there doesn't appear to be any significant revival in corporate numbers. On the other hand, we have still a very troubled situation on the global economy, which, there's no wishing it away. We have a very troubled situation on emerging markets in particular, because of the strength of the US dollar. There's weakening currencies across the board in the emerging market space. There are big redemptions being faced by funds that do only pure EM investing. We can't wish those very significant market-related factors away. So in light of that, my view is that the year ahead for large caps doesn't seem at all inspiring. And this has been actually my view for the last 12 months as well, that large caps, I don't see big economic tailwind, because large caps require big economic tailwinds to deliver numbers. Larsen & Toubro, or Levers, etc. They will need, a big revival of real GDP growth rather than just make-believe GDP growth. But that's not the same thing for small companies. And smaller companies can derive growth out of very micro factors, like a particular state doing well, or two states doing well, etc. So I have been focused more on the on the small cap space. And if you look at the performance of small caps versus large caps, I mean, it's a huge, divergence that you will see in the last 12 months. I see that divergence continuing, in fact, probably widening in the coming 12 months as well.
Okay, I mean, let me just take you up on the economy, on the on the lack of economic tailwinds. Falling interest rates, low commodity prices, NPAs more or less getting recognized, power distribution company reforms. Won't all this together bring growth?
Well, on the macro, I don't think there anything to disagree. I think things are looking okay. But whether that translates into growth big enough to drive corporate earnings up. See, it's not that we don't have growth. It's not that we are not going to see growth. Okay? But the pace of that growth is still tepid relative to what we require to show big numbers increase in corporate earnings. See, that is the central point. It's not binary that we don't have growth or we have growth. It is simply that the growth that we have and the growth that at least I see going forward is not adequate to move the needle for a Larsen & Toubro or move the needle for a Hindustan Lever. But can it move needles for smaller companies? For sure. So that is the point. I don't think we should take an extreme perspective in this. We have growth, but not enough growth required to sustain companies' market caps of 50,000, 1 lakh, 2 lakh crores.
Okay, for the last 3 years, we are starting with a 15% earnings forecast at the start of the year, and then we're ending in low single digits or even in middle single digits. Will FY17 earnings growth be the same, or do you expect it to, sort of rebound to high teens?
I mean, I think you said it, that, the sell side starts out with, high teens kind of number, and then by the time it actually translates into reality, we are down into the middle 5% or 6% or 7%. To talk about FY17, in my view, with still 2 full quarters left to go in this year, I think that's a little premature. But looking at the way things are, I don't see numbers being 18 to 20% kind of earnings growth in FY17 either. I would be very, very surprised if that were to happen.
Okay, well, I agree it's premature. Let me steer from the micro to the macro yet again. In the next 12, 24 months, what would be your best sectors or stocks? I mean, if you will talk.
I mean, I don't look 24 months out. I mean, the world is too fast moving for me to make such long range predictions. I do believe that mid and small caps are still on a tear, and I think if one has the option of not looking at large caps, one would like to exercise that option. I don't see anything exciting out there. The other thing I also see, and that's quite significant, is that because of the huge flow of capital into smaller companies in the unlisted space, which is the VC or the PE monies coming into smaller companies, I see big disruptions happening in larger companies' business models. And I don't think larger companies are equipped intellectually or from a purely organizational perspective to rework their business models that rapidly. And I know of several companies, largish companies, who are grappling with that problem because, to run something which is small today but which can potentially become big tomorrow, you need to have very fire in the belly youngsters out there doing it for you. But they don't want to work for a large company. They don't want to have a 5% stock option. They want to be owners. They want to run the businesses on their own. They want to own 50% or 40% of the companies. So large companies will have problems in reworking the business models. And you can see that across the world, not just in India. In India, in any case, large companies are very old business houses who are quite sclerotic in their perspectives. I see that as the other big issue coming up. I mean, if you take banks, for instance, the whole disruption that's going to happen in the banking space, a few years down the road, thanks to RBI's opening up taps on various micro banking, kind of businesses, those things can have quite severe knock-off effects on the larger banks. I'm just giving one example.
Yeah. Actually, Shankar, I agree with you on that, and I had written a piece myself on how a large part, definitely mid-cap PSU banks and probably old private sector banks can get wiped out by the payment banks. But are you telling me that, the payment bank challenges can be even severe on the large private sector banks?
If you think about it, a payment bank, in my view, is a perfect banking institution. I have a basic problem with banking as an industry, and this I have had intellectually for many years. Doesn't mean we have not liked banks as investments, But if you take a larger perspective, the banks basically leverage up their net worth 10 times, 15 times, and then they use that leveraged money to go and make loans. All you need is a bad economic cycle in which you will lose 5, 7, 8% of your capital, and basically that's all the capital you have in terms of what is the net worth. So you're going to wipe out your net worth every 4, 5, 6 years, and that we have seen that happen many, many times. You look at even NBFCs in India. I mean, some of them are running NPAs of 7%, 8%, which means basically you have no capital, right? You're really a zombie institution. Payment banks take away that big problem in banking as far as my thinking goes, which is that they're not required to make loans. It's not their business, okay? So they are only required to give it in risk-free instruments from the RBI. So that part being done, it becomes a purely liability-generating machine, right? And the people who have gotten the licenses, and in my view further people will get those licenses, are people who can make very micro liability collection centers, be it a mobile company or be it an e-governance company, where you can have a single person sitting in a village collecting deposits. That none of your large banks are capable of running branches. I mean, if you think about it, SBI, the largest branch network, about 15,000 branches, which is nothing, right, for a country this size. So, but the reason why they have only 15,000 is that they cannot make branches viable beyond that number. In fact, in my view, even 15,000 would be having large parts of loss-making branches, within them, right? So I see that the small ticket deposit business being completely taken away from payment banks. Okay, I'm not saying this is going to happen tomorrow, but look at a 5-year perspective, that your incremental deposit growth has to come from the underbanked areas of the economy, right? Or the unbanked areas. The large banks have no cost structures which allows them to do that.
Okay, you said the mid-caps are a fertile ground for stock picking. So let me ask you flat out, can you give us some stocks or even some sectors that can make the viewers or investors money in the next 1 year?
Sectors, I think, are safer in any case. And remember, I mean, for the average viewer of your channel, it's a very hard thing to go and pick a winning small cap or a winning mid cap, because we being full time into it, we have so many hits and misses in that, because it's promoter quality, business models, accounting, sanctity, a number of things go into it. It's beyond the reach of any small investor to be able to do that level of work. But that said, if you look at even infrastructure, which we know has been a very troubled sector. But within that, if you look at some of the smaller infrastructure companies, and there are many, it's like Ahluwalia or JMR, etc., they have done phenomenally well. I mean, Larsen & Toubro has done nothing, but the smaller ones have been multi-baggers. Because, as I said previously, that there is some growth in the economy, but not enough growth for Larsen & Toubro's order book to change market. But for the small company, the 1,000 crore turnover, he can get a 1,000 crore order book. He is looking at 100% growth year on year. You see, so that's the differentiation I'm making. Same industry, the large company doesn't have enough growth, but smaller ones do have adequate growth. So I'm just giving you one example where I see infrastructure being a good sector to get into, provided you've done your sort of analysis right. But the small cap infra looks quite interesting.
Point taken. Clearly a stock picker's market. But Shankar, drug companies, they were the classic defensives. And until recent weeks, when the spate of US FDA warnings brought a cloud over these companies, do you look at drug companies, mid-cap, large cap, small cap? Would they be still relative outperformers?
I think you can. I think, again, small cap pharma, some of the name of smaller mid-cap pharmas have done quite remarkably well. So, again, maybe the larger ones are also in terms of size of a size and scale that's going to be hard to keep replicating big numbers year on year. But again, in the small and mid-cap pharma space, there have been incredible number of winners. On the larger ones, the FDA problems have kept popping up from time to time. I mean, for several years, nothing new. I think the better ones find a way to deal with it, find a way to streamline their processes. And the FDA doesn't want to shut down our pharma companies. I mean, it didn't even shut down Ranbaxy, for God's sake. So, which was an absolute scam, which we all know. They didn't even shut Ranbaxy down. So I doubt if Dr. Reddy will be faced with a life and death situation. They will deal with it. It's a good company.
Okay, that point is taken. Since you're bearish on growth, will technology be the safe harbor, at least in the near term?
IT, well, I don't think it takes a genius to figure out only one thing, which is the rupee's direction. That I think we can all agree. But that said, again, IT I like within the context of a very troubled situation. But remember, that is a business that is ripe for again being sort of disrupted. So, I mean, you can never tell that Amazon, can become a huge IT company, and it already is a reasonably sized IT company through the Amazon Web Services. So who's to say they can't take away businesses from our IT giants who are in some senses very old economy, new economy companies. So, cloud can completely disrupt business models of our Indian companies. So while, right now looking good, longer term, there might be some question marks out there as well.
Okay. Well, from your conversation, should I take it that you're telling our viewers, leave it to the fund manager? Is that your main advice?
100%. I think there are very smart fund managers in India. I have a lot of respect for them. And there are very, very good small cap, mid cap funds out there. I think pick a good basket of them and then, relax. Because if you try to do it on your own, do it at home, I think it ends up in disaster.
That's important advice. 9100 on the Nifty. Is it the high? Will it be taken out in the next 12 months?
Sobering thought here is the dollar index has still not taken out the 2007 end highs. That is really a very worrisome thing. We can keep talking about the Nifty in nominal rupee terms, but the reality is that the big money obviously comes from overseas, and if you go back, we are still lower than where we were in 2007 end, which was the peak of the bull market. Right? Since then, we have been basically in a large trading range, if you will, and which is also an important thing to keep in mind, that not just India. If you look at emerging markets as a whole, okay, if you look at the ETF as being a representative of the entire basket, that ETF, the most liquid ETF on emerging markets called EEM, is at $33–34 now approximately, which is where it was in 2006. 10 years hence, zero returns. Okay, if you take a look at the US market itself, the S&P was about 1500 or 1600 in 1999. Okay, it's barely at 1900 or so now. So 16 years on, all you've got is, if you look at a CAGR, it's probably like a 2% CAGR over 16 years despite zero interest rates. Okay, Japan, long-term bear market. Europe, obviously nowhere close to the highs of 2007. So all we have seen in the last several years is a giant trading range in which if we've been lucky, we have caught the bottoms and sold at the top. But they have not been secular bull markets at all. Not in India, not in emerging markets, not in the US, not in Japan, not in Europe. That is a sobering thought. So within that context, remember, that's happening because large caps are not going anywhere. Nowhere. Okay, in the world. But small caps in the US or in India or in Japan, they have been on a tear. So I'm saying it's a larger global phenomenon on small caps. And that's because smaller ones are having models which are disrupting the larger ones.
Take your message, Shankar Sharma. Pleasure speaking with you. Thank you very much. Even if it's a sobering thought this Diwali morning, I think it's useful advice that growth is not happening really, or at least not in oodles in the large cap space, which is well analyzed, but in the mid and small cap space, where you require analysis, professional analysis, and a lot of research teams doing the work. So trust the fund manager, trust the fund management houses. That's the advice Shankar Sharma is also giving us. And like I told you earlier today, Sonia, this is precisely the advice that even Ramdev and Manish and Madhukela were giving us. Equities, yes, equities first, but equities professionally managed. That's the advice we are repeatedly getting. Well.